Chat. Why Apple's Mac supply crisis will trigger a 2T chip war in 2025. Apple's scrambling to meet AI Mac demand, and this just handed TSMC, Samsung, and Intel a $500 billion opportunity that will reshape the entire semiconductor market. Here's what everyone gets wrong about this moment. People see Apple's Mac mini shortage and think it's just another supply chain hiccup. They figure it'll resolve in a quarter or two and life goes on. But that's surface-level thinking. What's actually happening is far more significant. Apple's surprise inability to scale Mac mini production reveals something the industry has been avoiding. The infrastructure to manufacture AI-optimized chips at scale doesn't exist yet. Not really. For years, TSMC has been the undisputed champion of chip fabrication. They've had the capacity, the expertise, and the edge. Samsung's been playing catch-up. Intel's been struggling to rebuild. But none of them were truly stress-tested by a company like Apple, suddenly demanding massive volumes of cutting-edge chips optimized for on-device AI. The Mac Mini is just the visible symptom. What's underneath is a fundamental capacity crisis that's about to metastasize across the entire semiconductor industry. This isn't a temporary shortage. This is the beginning of a structural realignment where demand for advanced chip manufacturing capacity will exceed supply by a staggering margin. And that imbalance is worth trillions in value redistribution. The evidence is hiding in plain sight, but you have to know where to look. First, let's acknowledge what we know. Apple announced new Mac Mini models with M4 chips, positioning them as AI powerhouses for the creative and developer market. The demand signal was immediate and overwhelming. Within weeks, lead times stretched. Production couldn't keep pace. Apple, a company that's historically mastered supply chain logistics, couldn't get these units into customers' hands fast enough. Now, here's the critical part. This isn't because the M4 chip itself is hard to manufacture in isolation. TSMC makes these chips with the same precision and consistency they've demonstrated for years. The bottleneck is different. It's about manufacturing volume at the exact specifications Apple needs, on the exact timeline they need it, while simultaneously serving their iPhone production demands and managing commitments to other clients like Qualcomm, MediaTek, and AMD. Second piece of evidence. We're seeing early signal that Samsung is beginning to court Apple for secondary foundry partnerships. This never happens at scale without desperation from the buyer or aggressive positioning from the seller. The fact that this is even being discussed in industry circles tells you that Apple's procurement teams are losing confidence in TSMC's capacity to meet their AI Mac roadmap. Third, Intel's foundry division suddenly looks less like a desperation play and more like a strategic hedge. The company that was written off 2 years ago is now being positioned as a viable alternative manufacturing partner. That repositioning only makes sense if industry leaders are genuinely concerned about concentrating chip production in one location. The first thing that shifts is pricing power, and this shift happens at incredible speed. Within the next 6 months, you'll see TSMC begin raising prices for advanced node capacity. They'll frame it differently, of course. Maybe it's a premium for expedited delivery, or a specialized AI optimization fee. But what's really happening is that for the first time in a decade, a foundry has genuine leverage over its biggest customers. Apple can't walk away from TSMC, but Qualcomm, AMD, and others can be squeezed to create room for Apple's orders. This creates a domino effect. As TSMC raises prices, Samsung becomes viable at a higher cost basis. Suddenly, there's incentive to invest in Samsung's capacity. And Intel, having invested billions in their foundry ambitions, starts winning design wins they never thought were possible. We're talking about real volume commitments, not just experimental partnerships. The second thing that changes is geopolitics. The U.S. government has been subsidizing domestic chip manufacturing through the CHIPS Act. That money was meant to reduce dependence on Taiwan. But if Apple, a symbol of American innovation, is genuinely constrained by TSMC's capacity, The political pressure to accelerate Intel foundry funding and Samsung partnerships becomes irresistible. By Q2 2025, expect announcements about expanded capacity commitments, strategic partnerships, and probably some form of government incentive acceleration. TSMC wins in the short term but faces long-term margin compression. Samsung wins if they can execute on their advanced node roadmap. Intel's foundry division finally becomes a real business instead of a money-losing side project. The losers are the mid-tier chip designers and smaller companies that rely on affordable foundry capacity. As the big players Q-jump, costs rise for everyone else. We're talking about potential margin impacts of 200 to 400 basis points for companies without Apple-level negotiating power. If you're an investor, pay attention to foundry capacity announcements and long-term supply contracts. If you're building a hardware company, start diversifying your chip sourcing now. If you're in the semiconductor supply chain, this is your moment to understand where the real value migration is happening. The $2 trillion opportunity isn't really about Apple's shortage. It's about the structural reshaping of who controls the most valuable bottleneck in technology: advanced chip manufacturing at scale. Follow for more on the future of AI and business.